Welcome back to Investing Talk Podcast.
It is great to be back. And, looking at the market right now, it feels like we are living through history in real time.
It really does. I mean, we just saw the Dow cross the historic 50,000 mark. That is a massive psychological barrier. And despite all the noise, the S&P 500 is up almost 2%. And the tech sector is staging this incredibly sharp rebound. It feels like the market's trying to find its footing.
Exactly. We're seeing a lot of volatility, but also a lot of resilience.
Yeah.
And that is why today's topic is so crucial.
Okay.
In a market that's bouncing around like this, you want stability, but you also want growth. You want one of the reliable, magnificent seven.
Which brings us to our focus for today.
Today, we're looking at Microsoft.
The tech giant.
Yeah.
But before we get into the weeds, give us the so what here. Why Microsoft and why right now?
Because we're in the middle of what I call the CapEx wars. We are seeing a race for AI dominance that is unprecedented in scale.
Yeah.
We are talking about models like GPT-5 and Claude 4.5 coming online, and the infrastructure required to run them is massive. Microsoft is right at the center of this storm.
So they're spending big.
Huge. But they're also uniquely positioned to monetize it. The question isn't just how much are they spending, but can they win the race?
It's high-stakes poker with billions of dollars. I love it. As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out with the algorithm and lets us keep bringing you these deep dives.
But let's get into it.
All right, let's unpack the numbers. We've got the Q2 fiscal year 2026 report in front of us. And honestly, looking at the headline number, it's huge.
It is. They reported revenue of $77.7 billion for the quarter. That is strong double-digit year-over-year growth.
Wow.
But you have to look at where that money is coming from. It's not just selling Windows licenses anymore.
Right. The primary engine here seems to be the intelligent cloud segment.
Exactly. Azure is the star of the show. It is accelerating and has become the largest profit driver for the entire company.
And what's driving Azure?
It's AI workloads. We are seeing over 1,500 customers now using models like GPT-5 and Claude 4.5 on the Foundry platform.
That's a key detail I want to highlight. They aren't just relying on OpenAI's models exclusively. They're offering Claude 4.5 as well. It's that platform approach. But I'm looking at a specific stat here that just jumped out at me regarding the customer base.
You're looking at the whale clients.
Yeah. The number of customers spending over $1 million quarterly is growing nearly 80%. That is a staggering acceleration.
It really is.
That tells me this isn't just small startups playing around with chatbots. These are massive enterprise commitments.
It validates the strategy. Big business is moving its core operations to Azure to access these AI capabilities.
And management seems confident this will continue.
Oh, they're bullish.
Yeah.
If we look at the forward guidance for Q3 FY 2026, they are projecting revenue between 80.65 cents and $81.75 billion.
Which would represent, what, about 15 to 17% growth?
Precisely. And analysts are backing this up, forecasting annual revenue growth of around 13.7% and earnings growth of 13.1% per annum. So the trajectory is clearly pointing up.
Okay, the top line looks great, but I have to play the skeptic here for a second. We talked about the CapEx wars.
Yeah.
All this growth costs money. A lot of money.
It does.
We're seeing huge capital expenditures, and yet when I look at the balance sheet, it doesn't look like they're bleeding out.
That's the magic of Microsoft's financial health. They have incredible balance sheet stability. Yes, they have surging AI capex. We'll talk about the specific numbers later, but their cash flow from operations is so robust that is keeping pace with that spending.
So they're building things like the Fairwater AI superfactories, which are capital intensive, but they aren't facing a liquidity squeeze.
Not at all.
And they are still paying us, the shareholders.
They are. In Q2 alone, they returned $12.7 billion to shareholders via dividends and buybacks.
That is a massive number. $12.7 billion in 3 months.
And they've raised that dividend for 16 consecutive years. It's up 250% over the last decade.
So even with this massive pivot to AI, they haven't stopped rewarding the people who own the stock.
That is a very difficult balance to strike, and they seem to be managing it.
It's impressive. But let's talk about defense. You always talk about the moat with Amazon AWS and Google Cloud out there. How defensible is this position?
The moat is wider than ever, and it comes down to two things: switching costs and network effects.
Okay.
Think about the enterprise software stack, Microsoft 365, LinkedIn. Once a company is embedded in that ecosystem, the cost to switch away is just astronomical.
Right. Nobody wants to retrain their entire workforce on a new email system or word processor. It's a nightmare.
Exactly. And now they're integrating Copilot across M365 and GitHub. It creates this sticky ecosystem.
And on the Azure side?
The network effects are kicking in. They have the broadest selection of hyperscaler models. We mentioned GPT-5 and Claude, but they also have sovereign AI options like Mistral and Cohere.
So they are becoming the app store for enterprise AI models.
That's a great way to put it. And here is the metric that proves it's working. They have over 250 customers who are on track to process over 1 trillion tokens annually.
Trillion with a T.
Yes. That volume creates a defensive wall. It protects their market share against AWS and Google. Even if a competitor lowers prices, the integration and the scale Microsoft offers makes it very hard to leave.
It's a compelling fundamental picture. But fundamentals are one thing, how the market reacts is another. Let's pivot to the charts and see what the technicals are telling us.
Let's do it.
So looking at the price action, it's been a bit of a roller coaster. We had that post-Q2 earnings sell-off. The tech ETF dropped about 6% starting around January 28th.
Right.
Microsoft wasn't immune to that.
No, it wasn't. But look at what happened next. We got a bounce. And that bounce is significant. It signals a psychological breakout above those recent lows.
It feels like the market took a deep breath, looked at the numbers again, and decided the sell-off was overdone.
I think so. And context matters here. Remember, the Dow just crossed 50,000. Year to date, the market is up over 4.25%.
And Microsoft is a top Dow-weighted name.
When the index moves like that, Microsoft benefits from that broader momentum. It's implying higher highs are coming as we recover from that initial AI uncertainty pullback.
And there was a specific catalyst for this momentum that came from outside Microsoft, wasn't there?
Yes, the NVIDIA effect.
Right. NVIDIA came out and affirmed that their $660 billion AI CapEx figure is sustainable.
That was huge. When the leading chip maker says, yes, this spending is real and it's continuing, it spills over into Microsoft. It reinforces the narrative that this shared AI infrastructure is being built for the long haul.
It calms the nerves of investors who were worried this was a bubble about to pop.
It does. It confirms the hardware is being bought, which means the data centers are being built.
Speaking of data centers, I saw a headline about a company called Iron.
Yes, this is a really interesting technical signal. Iron is pivoting to Microsoft-backed data centers.
So we have infrastructure players aligning themselves specifically with Microsoft.
Yeah, exactly. It's just building momentum. Despite the volatility we saw with the earnings waves, the underlying flow of business is moving toward Microsoft's ecosystem. It's a bullish technical sign.
So the charts are looking constructive, recovering from that dip. But I want to get into the head of the average investor right now. Let's shift to sentiment. What is the market feeling?
This is where it gets fascinating.
I'm looking at the quantitative scoring here. The sentiment score for the top relevant stories is 0. Neutral.
Flat neutral.
I have to play the skeptic again. We just talked about double-digit revenue growth, massive dividends, and a technical breakout. Why is the sentiment score a big fat 0?
It's a tug of war. On one hand, you have headlines like Iron rises on Microsoft cloud expansion. That's positive.
Okay.
But on the other hand, you have broad headlines like tech had an awful earnings season.
Yeah, I saw that one. It specifically noted that Microsoft's earnings sparked some selling.
Right. The narrative out there in the news cycle is mixed. There is this lingering AI uncertainty. People are reading headlines about awful earnings, and it drags the sentiment score down, even if the specific company news is positive.
It seems like the algorithm is getting confused by the macro noise. But what about the humans? What are the analysts saying?
The analysts are cutting through the noise. They view the stock as undervalued.
Undervalued.
Yes. The consensus fair value target sits around $600.
That implies a significant upside from where we are trading now.
And they have a 4-star rating on it. They are looking at that 13.3% implied annual earnings growth and saying, this is cheap for what you were getting.
So the headlines are scary, but the spreadsheets are sunny.
That's often where the opportunity lies.
What about the big money, the institutions? Are we seeing them load up?
It's interesting. We aren't seeing specific cluster buying in the recent Form 4 filings.
Yeah.
No massive insider purchases screaming, buy now.
That's usually a signal I look for.
True, but you have to remember Microsoft's status. It's a Magnificent 7 stock. It's a staple. Right.
The institutional preference is almost implied. They don't need to aggressively accumulate in clusters because they already own it. And with $12.7 billion returned in Q2, institutions love that steady cash return.
So the lack of buying doesn't mean lack of interest. It likely means steady holding.
I think so.
Okay, so the institutions are holding steady, analysts are bullish, and the news bots are confused. But I want to take a hard look at the downsides. Let's look at where this goes wrong. This is the bear case.
Let's hear it.
I'm going back to the money.
Yeah.
We mentioned it briefly, but we need to stare this number in the face.
Mhm.
Projected capital expenditure is over $150 billion for FY 2026 and 2027.
It is a massive number.
$150 billion. That is the GDP of a small country. We're talking about the Fairwater AI superfactories and these massive buildouts. The risk here is obvious. Does this pressure margins?
Mm-hmm.
If revenue stumbles even a little bit, that cash burn looks terrifying.
It is a valid concern, and we saw that fear play out in real time. That post-earnings sell-off where the tech ETF dropped 6%, that was the market choking on that CapEx number. So investors are worried about AI spending concerns. They're asking, is this too much, too fast?
That's the question.
And it's not just the spending on buildings, it's the components. I'm reading about memory price hikes.
Yes, there's another volatility factor. If memory prices spike, it impacts the cost of goods for their on-prem servers and their data centers.
And that can eat into margins unexpectedly.
It introduces earnings volatility, absolutely.
So we have a massive fixed cost in CapEx and a variable cost risk in components. That sounds like a recipe for a margin squeeze.
If you look at it in isolation, yes. But here is the rebuttal.
I'm listening.
These risks are largely priced in. That dip we saw, that was the market pricing in the CapEx sphere.
Okay.
We are bouncing back because investors realize two things. One, the guidance for revenue growth is 15–17%. That is high growth. It justifies high spending. And two, the free cash flow coverage.
The safety net.
Exactly. Even with $150 billion in projected CapEx, their operations are generating so much cash that they aren't going into debt to fund this. They're funding it from cash flow and still paying dividends.
So the burn looks high, but the fuel coming in is even higher.
That's it. It prevents that liquidity squeeze that bears are worried about.
So your argument is that they can afford the gamble.
My argument is that it's not a gamble. It's a calculated investment that they have the checkbook to cover.
Fair enough. We've looked at the fundamentals, the charts, the sentiment, and the risks. It's time to make a call. Let's move to the verdict.
I'm ready.
Give us the score.
I am giving Microsoft a bullish score of 9 out of 10.
9 out of 10. That is incredibly high. Walk us through the investment thesis. Give me the elevator pitch for the listener.
It comes down to dominance and reacceleration. Microsoft is leading the AI revolution with Azure. We're looking at 15–17% revenue guidance for the next quarter. We have a company returning $12.7 billion to shareholders in a single quarter, while simultaneously building the most advanced infrastructure on Earth.
And the valuation.
It's undervalued. We have a $600 fair value target. The moat is real competitors are being crushed by the network effects and switching costs.
And you said something about reacceleration.
Right. And here's the kicker. We are seeing signs that Azure growth could reaccelerate to 40% via these frontier AI models.
40% growth on a base that big is unheard of.
Exactly. They're using this massive CapEx to fuel that reacceleration.
So what is the time horizon here? Is this a quick flip?
No, this is a multi-year hold. You hold this into the AI monetization phase. We are just at the beginning of customers processing those trillions of tokens. You want to own the toll booth for that traffic.
So buy the dip, hold for the long term, and watch the dividends roll in while they build the future.
That is the play.
It's a compelling case. The sheer scale of what they're doing with the Fairwater factories and the Foundry platform is hard to bet against.
But in a volatile market, having a Magnificent 7 anchor that is actually growing and paying you to wait, that is a rare combination.
Well, there you have it. A 9 out of 10 for the folks in Redmond. Thanks for breaking it down.
Always a pleasure.
And thank you for listening. This market is moving fast, and we are going to keep you ahead of the curve. As a final reminder, subscribe, like, and comment to support the show. Let us know if you think that $150 billion CapEx is a genius move or a risky bet. We'll see you on the next deep dive.